Welcome, dear students, to the massive open online course on money and financial markets. In today's module, we are going to talk about or discuss the Indian financial system. In other words, we would give you a brief overview of the Indian financial system. The basic objectives of this course of this module are as follows. We would like to identify the major changes that have occurred in the savings and investment trends in the context of the Indian economy. We would like to understand the overall development of financial institutions and financial markets in India. And thirdly, we would also try to explore the financial integration that has taken place in the financial sector of the Indian economy. Now, if we try to look at the Indian financial system at present, the striking feature of it is the prodigious growth of the Indian financial system in the last 75 years in terms of its size, diversity, sophistication, and complexity. Significant diversion and innovations in respect of an array of financial institutions, instruments, and services have been observed in the context of the Indian financial system. We now have a diversified structure of financial instruments, a fairly diversified portfolio of financial claims. Significant reorganization, globalization, privatization, deregulation, automation, computerization, changes in ownership, consolidation and merger of financial institutions have really been effected. A veritable financial revolution appears to have occurred in India over these years. If we look at the trends in the savings and investment in the Indian economy, we find that there has been a consistent increase in the savings rate. Basically, the gross domestic savings as a ratio of GDP. Throughout the post-independence period. So, in the early 1950s, it was around 10%. It increased to 17% in the early 1970s. And then, during 2000, it was around 25%. And in 2014-15, it was around 37.2%. So, we can say that there has been a consistent increase in the gross domestic savings rate of the Indian economy as a proportion of GDP. Private savings had always accounted for a lion's share of the total domestic savings throughout, with public savings declining from early 1980s onward. Household savings has remained by far the most important component within the private saving despite the growth of corporate savings. The share of household savings in the total private savings declined marginally for over 88% in the early 1950s to around 84% in the late 90s, reflecting the increased corporate saving from 1% to 3.6% of India's GDP over this period. The private corporate sector savings has increased continuously up to 2007-8, but after that it has declined and has shown a fluctuating trend that is low, and this can be explained by the fact that the companies might have low profitability during the financial crisis. India's public savings rate steadily increased from 1.7% in the early 50s to around over 4% in the early 70s, and then it started declining persistently to less than 1.4% in the late 90s. Public savings accounted for a mere 7% of the total savings by the late 90s from over around 20% in the late 70s. A decline which we can attribute to because of an increasing fiscal deficit during this period. And in fact, it should be noted that during the year 2000-2001, it was nearly negative. Now, let us look at the investment pattern. The average investment ratio in the Indian economy had increased from 9.3% in 1950-51 to around 38.11% in 2007-2008. The reason can be manifold. It could be due to the moderate tax rate coupled with buoyant sales growth, which increased the internal accruals of the corporate sector. And during 2009 to 2015, we also see a fluctuating trend in the context of investment. The improved investment climate and strong macro fundamentals also led to an upsurge in FDI. The higher investment was able to absorb the domestic savings and also generated an appetite for absorption of capital inflows from abroad. The household sector has been the only sector in surplus in India, while the investment of the private, corporate and public sectors has always far exceeded their respective savings. We now look at the overall development of financial institutions and financial markets in India. Over the post-independent period, the financial sector in India has really grown manifold. The number of regulatory bodies have increased. Apart from RBI, which is a central bank of the country, we had the SEBI, which looks after or supervises the securities of the stock exchange or the stock markets. We have the IRDA that regulates and supervises the insurance sector. We have the PFRDA, which looks at the provident funds, and all these bodies were established to supervise these various financial sectors. The number of commercial banks have also increased in India, and their operations in the rural sector have also increased manifold. And obviously, this has helped in the process of financial inclusion in the context of the Indian economy. However, the growth of the cooperative banks have not really been very impressive. The post office functions have undergone a rapid change. They now offer many services and instruments which have basically encouraged the volume of small savings in India. The government have also introduced the new pension scheme. Previously, only 11% of the Indian population was under pension, under the coverage of pension. But now the NPS or the new pension scheme strives to include as many people as possible under the scheme, so that social security can be made stronger for them. The insurance sector have also grown manifold after private players have entered this area. Deregulation have resulted in more diversified insurance product offerings with stress on marketing and distribution strategy. The mutual funds have also increased, and it has become an alternative mode of investment for the common man through which people can invest their surplus funds to maximize their return. The non-banking statutory institutions like the NABARD, the Exim Bank have also expanded their business. We now look at the status of the securities market before 1992 and by 2009. If we look at one of the features as the regulator, we find that in the pre-1992 period, there was no specific regulator, but only the central government who used to overlook the whole thing. But from 2009, we find that there is a specialized regulator for securities market, which was created SEBI in 1992, and they were vested with powers to protect the investors' interest and to develop and regulate the securities market. If we look at the securities, we find that pre-1992, there were limited number of traditional instruments. But in the present sphere, we know that it has been expanded to cover government securities, mutual funds, derivatives of securities, security receipts, and so on. Previously, pre-1992, the form of securities were physical in nature, but now it is dematerialized through enabling legislation. It was a merit-based regulation in the pre-1992 period, but now it is rather a disclosure-based regulation which was created in 1992. If we look at the access to market, in the pre-1992 period, the securities were granted by the central government. But after that, we have eligible issuers access the market after complying with the issue requirement as detailed in regulation under the SEBI Act of 1992. In the context of access to international markets, in pre-1992, the securities basically had no access to international markets. But after 1992, we find that corporations were allowed to issue the ADRs and the GDRs and raise the commercial borrowing, the ECBs. The ADRs and GDRs have limited two-way fungibility, and mutual funds were also allowed to invest overseas. Foreign institutional investors were allowed to trade in the Indian markets. So these were certain new things that we find here. In terms of corporate compliance, previously pre-1992 there was very little emphasis on corporate compliance, but nowadays there is an emphasis on disclosures, on accounting standards, on corporate governance. Even in the context of mutual funds, in the pre-1992 period, it was restricted totally to the public sector, while now it is open to the private sector, and there is the emergence of various types of funds and schemes. Even if we talk about the basis of settlement, we find that previously in pre-1992 there was type of bilateral netting, but now it's a type of multilateral netting. And in terms of transferring of securities, previously it was very cumbersome. The transfer by endorsement on security and registration by the issuer was carried out, but now the securities are freely transferable. Transfers are recorded electronically in book entry form by the depositories. So from the securities market, let us look at the equity market. Though India has, in the Bombay Stock Exchange, one of the oldest stock exchanges in Asia and the world, the country's modern securities market history really starts only in the 1990s. Because in this period, starting in the mid-90s, the Indian security market has many firsts to its credit. It established for the first time demutualized stock exchange in the world. All stock exchanges in India today are corporatized and demutualized. The Indian securities market was the first to use satellite-based communication technology for securities transaction. It was the first to introduce straight-through processing in securities transaction. The growing number of market participants, the growth in the volume of securities transactions, the reduction in transaction cost, the significant improvement in efficiency, transparency and safety, and the level of compliance with international standards have earned for the Indian securities market a new respect amongst all the securities market in the world. In addition to this development, thanks to the massive liberalization that was ushered in the Indian economy in 1992, the securities market in India has grown exponentially as measured in terms of the amount raised from the market, in terms of the number of participants, in terms of the number of listed stocks, market capitalization, trading volumes and turnovers in the stock exchange, and of course the investor population. Next, we focus on the equity derivative markets. India's tryst with exchange-traded equity derivatives began only in this century. Trading first commenced in index futures contracts, followed by index options in June 2001, individual stock options in July 2001, and single stock futures in November 2001. Since then, equity derivatives have really come a long way. An expanding list of eligible investors, rising volumes, and the best of risk management framework for exchange-traded derivatives have been the hallmarks of the history of equity derivatives in India so far. India's experience with the launch of the equity derivative market has really been extremely positive. The derivatives turnover on the National Stock Exchange of India has surpassed the equity market turnover within 4 years of the introduction of the derivatives. In comparison with the early 90s, if we look now at the money markets are currently better in terms of depth, and as a result of various policy initiatives, activity in all the segments has increased significantly, especially during the last few years. With the development of market repo and collateralized borrowing and lending obligation segments, the call money market has been transformed into a pure interbank market since August 2005. In the interest of financial stability, the uncollateralized overnight transactions are now limited to banks and primary dealers. However, there are volatility in the call rates. This has declined over the years, especially after the introduction of LAF or Liquidity Adjustment Facility. There also has been a reduction in the bid-ask spread in overnight rates, which indicates that the Indian money market has become reasonably deep, vibrant and liquid. However, though the money market is free from interest rate ceilings, structural barriers and institutional factors continue to create distortions in the Indian money market. Apart from the overnight interbank rate, that is a call market rate, the other interest rates in the money market are sticky and they appear to be set in customer markets rather than the auction markets. A well-defined yield curve does not therefore exist in the Indian money market. Finally, we look at the financial integration of the Indian financial system. Integration of financial markets is a process of unifying markets and enabling convergence of risk-adjusted returns on the assets of similar maturity across the markets. The process of integration is facilitated by an unimpeded access of participants to various market segments. Integrated financial markets assume vital importance in an economy for several reasons. Number one, integrated markets serves as a conduit for authorities to transmit important price signals. Secondly, efficient and integrated financial markets constitute an important vehicle for promoting domestic savings, investment, and consequently economic growth. Thirdly, financial integration fosters the necessary condition for a country's financial sector to emerge as an international or a regional financial center. Fourthly, financial market integration by enhancing competition and efficiency of intermediaries in their financial stability. Fifthly, integrated markets leads to innovations and cost-effective intermediation, thereby improving access to financial services for members of the public, institutions, and companies alike. Sixthly, integrated financial markets induce market discipline and informational efficiency. Seventhly, market integration promotes the adoption of modern technology and payment systems to achieve cost-effective financial intermediation services. What we see that until the early 1990s, India's financial sector was tightly controlled. The interest rates in all market segments were administered. The flow of funds between various market segments was restricted by extensive micro-regulations. There were also restrictions on participants operating in different market segments. Banks remained captive subscribers to government securities under statutory arrangements. The secondary market of government securities was dormant. If we look at the equity market, we find that the new equity issues were governed by several complex regulations, restrictions, etc. And the secondary market trading of such equities basically lacked transparency, they lacked depth. The foreign exchange market had remained extremely shallow because most of the transactions were governed by inflexible and low limits under the exchange regulations, and there were prior approval requirements. The exchange rate was also linked to a basket of currencies. Although the financial sector grew considerably in the regulated environment, it could not really achieve the desired level of efficiency. Compartmentalization of activities of different types of financial intermediaries eliminated the scope for competition among the existing financial intermediaries. So, when we look at the market integration or financial integration in the Indian market, we find that it has taken several phases, because various segments of the financial markets have become better integrated in the reform period, especially from the mid-1990s. The first phase refers to the early transition period of the 1990s, and the second phase is a period of relative stability in the financial market from 2000 onwards. In the first phase, we have the domestic financial markets which witnessed modest integration, while in the second phase, that is beginning from 2000 onwards, it reflects a period of broad stability in financial markets. However, there were intermittent phases of volatility. This was also observed. The process of financial market integration was more pronounced during this phase. A growing integration between the money, gilt and the foreign exchange market segment was also visible during the latter phase. So, we do observe financial market integration taking place in India phase-wise, but obviously at a very positive rate. And we also noticed that in the context of the financial system of India, if we look at the history of every segment of the financial sector, there has always been a very positive advancement, and there are many things for which the Indian economy or the Indian financial sector can really boast of. And of course, it does have a direct correlation with the economic growth of the country. Thank you.